we're seeing a lot of the quote unquote endgame play out as we see, with all of the civil unrest. That's all totally related. And one of the points that I would make is that we've seen real GDP per capita from, let's say, like the 50s to the 80s was growing in the high twos to low threes on a really sustained basis. We've seen that drop to about 1.2, 1.3% on a long-term basis. But that's just an average of real GDP growth. As you mentioned, our wealth concentration is pretty extreme. So even though real GDP per capita is 1% on average, there could be, I don't have the exact numbers, but there could be 40, 50, 60% of the population that's already experiencing a decline in their standard of living. So that civil unrest is manifesting itself in a lot of different ways, including a higher demand for transfer payments, which in my model is going to exacerbate the situation in terms of real GDP. I think it's going to make that worse. Where the end game gets kind of interesting for me is that, a lot of the inflation camp, and perhaps you can comment on this because I'm curious, is that we can solve some of this through inflation. Where I tend to get a little tripped up with that is if the target that we're looking at is increasing people's standard of living to quell some of the social unrest, we need to do something to raise real GDP per capita. Debasing the currency or inflation doesn't seem like it's going to achieve that goal, which may not result in any less unrest than we're seeing. The second thing is I don't think we have as precise of a way to devalue the currency as we did when we were pegged to gold. And I think that we lend ourselves to competitive devaluations from other developed countries. The third thing is that devaluation may help our current debt load as it stands today at the government level, but the largest component of our future liabilities are the entitlement programs. I think today we have something like $3 or $4 trillion of current entitlement programs. That's obviously going to balloon over the next 5 to 10 years. All of those entitlement programs, I believe there was a study that showed maybe 19 or 20 of the programs have either explicit or implicit inflation links within them. So they're all linked to inflation. So if we have 5, 6, 7% inflation, it may reduce our current debt load, but it's not going to do a heck of a lot for our future debt load because it's all basically linked to inflation. So one of the things that we're going to have to grapple with are these entitlement issues. And whether we remove the link to inflation, to me, that's some form of austerity because you're giving people less than what they were promised. So I think that there's going to have to be some form of austerity that comes down the road. And I know people freak out when they hear the word austerity because it's never possible. But when we think about inflation as a solution, inflation is not going to solve the entitlement burden all that much. So I think that we continue to grind towards weaker and weaker growth, and the social unrest gets worse and worse until we either grapple with the debt situation or we have a big problem with the currency. I think that the inflation as it relates to money supply can be tricky, because if I let's say print $1 trillion of currency and then I light it on fire, that's not really inflationary. So as far as the basket of goods and services, why that's important is because that's what plays into TIPS calculations, and that's what plays into the cost of living adjustments with a lot of the entitlements. So as much as people hate those metrics, we have to use those metrics because that's what is a huge factor in our future deficits, and as well as in the fixed income market. So I think we have to look at where the money supply growth is coming from. And if we look at it over the last year, let's say, and we continue doing what we're doing, a lot of it is coming from quantitative easing in the secondary market, which is causing a huge rise in deposits at the banks. And if you take a non-bank that had a treasury, and then you take the treasury away from them and give them cash in the form of a deposit, they're not going to invest that going to the store and buying a sandwich. They're going to recycle that back into financial assets. So I think that the financial asset inflation can continue. And it can continue as long as this is the way that we're deciding to increase the money supply. I don't think that adversely affects treasury investors who are targeting more of nominal GDP growth, because nominal GDP growth won't increase really in that scenario. The second thing I would note is that game can continue, and it's not that the market will rise in perpetuity as long as QE is going on, because one of the things we have to realize is that at the end of the day, these are equities that need to be serviced. Their debt needs to be serviced with cash flow. So, a company that may be in good standing with their debt can see their equity valuation rise quite dramatically. But if the underlying economy gets so weak because all the money supply is going back into financial assets, then at some point, some company somewhere is literally not going to be able to make payment on their bond. A commercial real estate, for example, will literally not be able to make payment, and then that asset is literally in default. There's currently no mechanism for the Fed to buy defaulting assets at the moment. So it could be akin to a scenario where you increase money supply and light it on fire, in the sense that it could cause this really sharp rise in the equity market. But if the underlying economy gets so weak that a lot of these companies don't have the cash flow to support their bonds, they end up in bankruptcy. So we could see a large rise in the money supply, goes into the equity market, and that paper wealth kind of vanishes. That could also be a deflationary outcome. So I think that holding bonds in this scenario only gets quite dangerous if nominal GDP is rising on a sustained basis. And for that, I would use some of my shorter term leading indicators to give me a heads up as to when that's happening, which it is now. So I'm not I'm not overweight long-term bonds at all. Actually, I'm actually underweight long-term bonds in this scenario, because the expectation that nominal GDP growth is going to increase. But the wild mania speculation and QE fueled asset price inflation, to me, doesn't work against the bond allocation all that much. Specifically, if you have a balanced portfolio that does have a fair amount of equities within it, as well as gold, as well as aside from your securities portfolio, a physical allocation to gold. In that scenario, I think that bonds still do play a critical role in an overall portfolio. How do we move forward in the next downturn, when our move in the past was basically just smash real interest rates? How do we do that going forward? And that's going to be a challenge, I think.